Disclaimer.
First of all, thank you all for your loyalty. More and more of you are following my content, and I appreciate it. For more content, please subscribe and like. Picture this scenario. You're a procurement manager at a major solar panel manufacturer in Arizona, and you've just received an email that makes your stomach drop. First of all, thank you all for your loyalty. Your silver supplier in Mexico can't guarantee delivery of the 50,000 ounces you ordered for March production. Not delayed, uncertain. The reason? 2 oil tankers seized off Venezuela's coast 3 weeks ago have triggered a domino effect that is now threatening to shut down critical shipping lanes carrying far more than just crude oil. December 2025 brought something that should grab our attention immediately. The U.S. Navy intercepted and seized 2 vessels, the Skipper and the Centuries, forcing more than 11 million barrels of Venezuelan oil to sit offshore with nowhere to go. Tankers that were already en route started turning around mid-journey, captains refusing to risk their cargo in waters where the rules changed overnight. But here's what the headlines missed. Those same Caribbean shipping lanes carry refined silver from Mexican mines, industrial metals from South American refineries, and components for every technology we consider essential to our economic future. While that drama unfolded in the Caribbean, something equally remarkable happened in precious metals markets that most Americans completely missed. On December 24th, 2025, silver touched $72 per ounce. Think about what that number represents. A 120% gain in a single year, blowing past the old all-time highs that stood for decades. The price action alone tells us something fundamental shifted in global silver markets, but the real story lives in what's happening to the physical metal itself. Have you noticed that when financial assets double in value, everyone from CNBC to your neighbor suddenly becomes an expert with an opinion? Yet silver's historic surge barely registered in mainstream coverage, almost as if the financial establishment would prefer we didn't look too closely at what is actually driving these numbers. The disconnect between paper price and physical reality has never been wider, and that gap contains a warning that impacts every American who owns electronics, drives a car, or depends on renewable energy. Here's where the situation gets genuinely concerning for our economy. The COMEX and London Bullion Market Association warehouses, which serve as the backbone of global silver trading, are experiencing something they've never seen at this scale. Their combined inventories have collapsed to 12-year lows, according to data from the Silver Institute and major bullion dealers. We're not talking about a minor drawdown. These are the stockpiles that industrial buyers depend on when they need physical metal delivered to factories. When those reserves evaporate, the entire supply chain faces a problem that can't be solved by printing more dollars or negotiating better prices. Let me put this in perspective with numbers that should concern anyone paying attention to supply and demand fundamentals. For 5 consecutive years, global silver consumption has exceeded mine production. The deficit in 2024 alone reached 500 million ounces, meaning we collectively used 500 million more ounces than miners extracted from the earth. That shortfall had to come from somewhere, and it came directly from those COMEX and LBMA vaults that are now running on fumes. You can drain your savings account to cover expenses for a while, but eventually the math catches up with reality. Now add the second choke point that's operating simultaneously with Caribbean naval operations. The Red Sea attacks that began in late 2023 haven't stopped. They've become the new normal for maritime shipping. Roughly 10% of all global trade flows through those waters, and every ship captain now calculates risk premiums before committing to routes that might result in missile strikes or forced detours around the entire African continent. What happens when the Caribbean becomes unstable at the exact moment the Red Sea remains dangerous? We get a dual choke point effect that transforms shipping from a predictable logistics problem into a strategic gamble. Think about the impossible choice now facing industrial buyers who need physical silver to keep production lines running. Solar panel manufacturers, electronics companies, and electric vehicle producers don't have the luxury of waiting for better prices or safer shipping lanes. Their factories either receive silver deliveries on schedule or they shut down, sending workers home and leaving unfilled orders that ripple through the entire supply chain. According to conversations with major bullion dealers and manufacturing executives, these buyers are now facing delivery delays of 4 to 8 weeks for orders they used to receive in days. And they're paying premiums of $8 to $15 above spot price for the privilege of getting physical metal at all. You might wonder why this matters to everyday Americans who do not work in solar manufacturing or electronics production. Consider what happens when the components that power our daily lives become scarce. Your smartphone contains roughly 1 gram of silver in its circuitry. Electric vehicles use up to 30 grams in their electronics and battery management systems. Every solar panel installation in our push toward renewable energy requires significant silver content that has no substitute at current efficiency levels. When the industrial buyers who manufacture these products can't secure metal, the shortage doesn't stay confined to commodity markets. It shows up as higher prices, delayed deliveries, and eventual scarcity of the technologies we've come to consider essential. The convergence of these factors creates something financial markets haven't priced in yet, even with silver at $72. Naval operations in the Caribbean aren't temporary political theater. The USS Gerald R. Ford Carrier Strike Group remains deployed, signaling ongoing commitment to enforcing restrictions that directly impact shipping routes. The Red Sea situation shows no signs of resolution, with maritime insurance rates reflecting permanent risk premiums for vessels transiting the region. Meanwhile, those warehouse inventories continue declining every single day that industrial demand exceeds mine supply. And there's no scenario where that equation reverses in the near term. What we're witnessing is a typical commodity price cycle where high prices eventually bring more supply online and restore balance. This situation has different characteristics that should concern anyone paying attention to how our economy actually functions. The metal sitting in vaults represents the last buffer between current demand and a genuine allocation crisis, where buyers can't obtain silver at any reasonable price because the physical metal simply aren't available in the quantities required. Once that buffer disappears, and the data suggests we're measuring that timeline in months, not years, the market transitions from price-based distribution to something far more unpredictable. The question facing American investors, manufacturers, and policymakers isn't whether silver reaches some specific price target. The real question is, what happens to our industrial economy when a critical input material becomes subject to geopolitical forces that override normal market mechanisms? We've spent decades building supply chains optimized for cost efficiency and just-in-time delivery, and now those same supply chains face disruptions that our economic models never anticipated. The seized tankers in the Caribbean represent just one visible symptom of a larger systemic vulnerability that threatens far more than crude oil shipments. What if I told you that one industry alone now consumes a quarter of all silver mined globally, and that industry's demand is projected to double within the next 5 years? According to the Silver Institute's comprehensive market analysis, industrial demand for silver reached 665 million ounces in 2024, setting an all-time record that shattered previous consumption levels. But here's the detail that should make every American paying attention to energy policy take notice. Solar panel manufacturing accounted for 25% of the total, and the International Energy Agency project's solar installations will need to double by 2030 to meet our climate commitments. Let me walk you through what those numbers actually mean for our economy. Every megawatt of solar capacity requires approximately 20 ounces of silver for the photovoltaic cells that convert sunlight into electricity. The United States alone plans to install hundreds of gigawatts of new solar capacity over the next decade as part of our transition away from fossil fuels. That's not a political statement. It is current policy under the Inflation Reduction Act and various state-level renewable energy mandates. When you multiply those installation targets by the silver required per megawatt, you get a demand curve that looks more like a vertical wall than a gradual slope. Now let's examine the supply side of this equation, where the numbers become genuinely alarming. Mexico produces more silver than any other country on Earth, delivering 232 million ounces annually from its mines. The Mexican production represents the backbone of Western Hemisphere silver supply, feeding refineries and manufacturers throughout North and South America. But according to data from mining technology and industry analysts tracking mine life cycles, Mexico faces an approaching cliff that will reshape global silver availability within the next 5 years. Think about the specific mines that are reaching the end of their productive lives right now. The San Julian mine, one of Mexico's largest silver producers, will exhaust its economically viable reserves by 2027. The Mercedes mine and Dolores mine face similar closure timelines, with production already declining as ore grades diminish and extraction costs rise. What's missing from this picture? The major new discoveries and development projects that would normally replace aging mines and maintain production levels. Despite record silver prices providing every incentive for exploration and mine development, the industry hasn't announced new projects at anywhere near the scale needed to offset these closures. You might assume that high prices automatically solve supply problems by making previously uneconomic deposits viable for mining. That's the theory taught in economics textbooks, but reality proves far more complicated when we're talking about hard rock mining with multi-year development timelines. Finding a silver deposit, securing permits, building infrastructure, and bringing a mine into production requires 7 to 10 years under optimal conditions. The mines scheduled to close by 2027 needed replacement projects started years ago, and those projects don't exist. We're not facing a temporary supply squeeze that resolves itself with higher prices. We're looking at structural supply destruction with no mechanism for rapid replacement. Here's where the situation gets even more interesting for anyone tracking the disconnect between paper markets and physical reality. Major bullion dealers across the United States are reporting something they've rarely seen at this scale. 100-ounce silver bars, the standard product for industrial buyers and serious investors, are trading at premiums of $8 to $15 above the spot price you see quoted on financial news. Think about what that premium represents. Buyers are so desperate for physical metal that they're willing to pay up to 20% more than the official market price just to secure delivery. Have you ever tried to buy something where the advertised price and the actual price you pay are completely different? That's exactly what's happening in silver markets right now, and it tells us that the paper price tracked by futures contracts has diverged from the reality of obtaining actual metal. According to conversations with dealers and manufacturing procurement managers, delivery times that used to be measured in days now stretch to 4 to 8 weeks, assuming you can secure an allocation at all. The silver is there on paper, tracked in electronic ledgers and futures contracts, but when industrial buyers need physical bars delivered to factories, they're discovering that paper promises don't power production lines. The financial establishment has started acknowledging what market participants already know. Citigroup's commodities research team issued price targets calling for silver in the 70s, while Bank of America analysts project $65 as their base case for 2026. These are not fringe conspiracy theorists or permabulls trying to pump their positions. These are major Wall Street institutions with research departments that built their reputations on sober analysis. When Citi and BofA start publishing triple-digit silver scenarios, it signals that something fundamental has shifted in how institutional investors view this market. The mining executives running the companies that actually produce silver are even more direct in their assessments. Keith Neumeyer, CEO of First Majestic Silver, one of the world's largest primary silver producers, has publicly stated his expectation for triple-digit silver prices based on supply-demand fundamentals he's witnessing from inside the industry. These aren't financial analysts making predictions based on chart patterns. These are the people operating the mines, negotiating with refiners, and talking to industrial buyers who need physical metal. When mining CEOs predict price levels that would have seemed absurd just 2 years ago, we should pay attention to what they're seeing in real-world supply chains. Let us add another layer to this puzzle by examining what's happening in the world's largest consuming markets. India's silver imports surged 300% year over year according to customs data and precious metals trade associations. Indian buyers, known for their sophisticated understanding of precious metals, markets built over thousands of years of cultural tradition, are accumulating physical silver at unprecedented rates. This is not Western financial speculation. This is generational wealth being shifted into tangible assets by people whose grandparents remember what happened when paper currencies failed. China presents an even more complex dynamic that Americans need to understand if we want to grasp where this situation leads. Chinese refineries control approximately 40% of global silver refining capacity, processing ore and recycled material from around the world into the standardized bars that industrial buyers require. Over the past decade, China systematically built this refining dominance while Western countries allowed their capacity to atrophy, prioritizing short-term cost savings over strategic control of critical material supply chains. Now we face mounting tensions between the United States and China over trade, technology, and Taiwan, and we've handed China enormous leverage over a material essential to our industrial economy. What happens if Chinese officials decide that domestic demand for silver in their own solar, electronics, and EV industries takes priority over exports to Western buyers? We're not speculating about unlikely scenarios. China has demonstrated willingness to restrict exports of rare earth elements, gallium and germanium, when strategic interests warranted such actions. Silver refining capacity can't be rebuilt overnight, and the Western industrial base depends on Chinese refineries for the steady flow of standardized product that our manufacturers require. The geopolitical dimension of silver supply adds another layer of risk that financial models never priced into commodity markets. Put all these pieces together, and you start to see why the situation has institutional investors and industrial buyers genuinely concerned. We have record industrial demand that's structurally locked in by our renewable energy commitments. We have major mine closures approaching with no replacement projects ready to maintain production levels. We have physical premiums and delivery delays signaling acute tightness in available supply. We have Wall Street institutions and mining executives predicting prices that would have been dismissed as fantasy just months ago. And we have Eastern accumulation accelerating at the exact moment Western warehouse inventories hit multi-decade lows. The mathematical reality of 500 million ounce annual deficits meeting 600 and 65 million ounces of non-negotiable industrial demand creates a scenario where the physical market breaks away from paper price discovery entirely. When procurement managers can't secure metal for production lines, they don't check the COMEX futures price and wait for better levels. They pay whatever premium is necessary to keep factories running. That dynamic, multiplied across every solar manufacturer, electronics producer, and automotive company dependent on silver, creates buying pressure that overwhelms available supply regardless of price. Let's do the math that Wall Street analysts are running in private conversations with institutional clients. Start with the 500 million ounce annual deficit that's been running for 5 consecutive years. Add the 665 million ounces of industrial demand that ain't be reduced without shutting down factories and abandoning our renewable energy commitments. Now factor in the Mexican mine closures accelerating between 2025 and 2030, removing millions of ounces from a supply base that's already insufficient. What does that equation produce? A market structure where physical silver becomes allocation-based rather than price-based, fundamentally different from anything we've experienced in modern commodity markets. Think about what allocation-based distribution actually means for American manufacturers and investors. In a normal price-based market, anyone willing to pay the current price can obtain the product they need. Supply and demand find equilibrium through price adjustments that incentivize more production when demand exceeds supply. But when annual consumption structurally exceeds production by hundreds of millions of ounces every single year, and when the buffer inventories are depleted to 12-year lows, the market transitions to something resembling wartime rationing. Procurement managers who've maintained relationships with suppliers get allocations. Buyers who show up late or lack established connections discover that no price secures delivery because the metal physically does not exist in quantities required. Commodity analysts tracking these dynamics have started publishing price targets that reflect this mathematical inevitability. Multiple research firms now project silver reaching $100 per ounce by the second quarter of 2026, with some scenarios modeling spikes to $150 or higher if Chinese export restrictions materialize. These aren't speculative predictions based on chart patterns or investor sentiment. These are calculations derived from the simple reality that 665 million ounces of non-negotiable demand meeting supply that falls short by 500 million ounces creates a shortage that can only resolve through dramatic price increases or industrial shutdowns. But here's what should really grab our attention as we head into 2026. 3 specific trigger events are converging in the first quarter that could accelerate this timeline dramatically. Understanding these triggers matters because they represent the narrow window before physical silver becomes effectively unavailable at any reasonable price for buyers who didn't secure supply in advance. Trigger number 1 involves the ongoing naval situation we discussed at the beginning. The USS Gerald R. Ford carrier strike group remains deployed in the region, and there's no indication of imminent withdrawal. Defense analysts and shipping industry sources report that this deployment represents a sustained commitment to enforcing restrictions that directly impact Caribbean shipping routes. Every week that Carrier Group operates in those waters adds risk premiums to shipping insurance and creates uncertainty for vessels transporting commodities from South American producers to North American buyers. This is not a temporary crisis that resolves itself. This is the new baseline for maritime operations in a region critical to our silver supply chains. Trigger number 2 hits in February 2026, when major solar manufacturers must finalize supply contracts for the calendar year. Industry data shows that solar production accounts for roughly 40% of annual industrial silver demand, and these manufacturers typically secure the bulk of their yearly requirements during first quarter contracting seasons. Think about the pressure building on procurement teams right now. They see current spot prices around $72. They see physical premiums of $8 to $15. They see delivery delays stretching to 2 months. And they know their production lines stop without guaranteed silver deliveries. What happens when dozens of solar manufacturers simultaneously try to lock in supply for 2026 production? The concentrated buying pressure hits a market where available inventory already sits at 12-year lows. Trigger number 3 lives in the COMEX warehouse data that anyone can verify through exchange reports. Registered silver inventory, the metal actually available for delivery against futures contracts, has fallen below 30 million ounces, the lowest level since 2016. Meanwhile, open interest in COMEX silver futures remains above 120 million ounces. Let me translate what that ratio means. For every ounce of physical silver registered for delivery, there are more than 4 ounces worth of paper contracts claiming ownership. In normal markets, that leverage works fine, because most contracts settle financially rather than demanding physical delivery. But when industrial buyers need actual metal and start standing for delivery, that 4-to-1 leverage becomes a detonation mechanism that forces cash settlements at prices far above official quotes. Have you noticed how financial crises always seem to arrive faster than the experts predicted? That's because markets can remain stable right up until the moment multiple stress points converge, and then the transition happens in days rather than months. We're looking at a scenario where naval operations create ongoing shipping uncertainty. Solar manufacturers trigger panic buying in February, and COMEX inventory hits levels where the exchange physically cannot deliver against outstanding contracts. Those 3 triggers hitting simultaneously in the first quarter of 2026 could transform the current tight market into an outright supply emergency. The timeline before $100 silver closes within 60 to 90 days based on these converging factors. That's not a marketing pitch designed to create urgency. That's the assessment of commodity strategists tracking industrial buying patterns and exchange inventory data. Once solar manufacturers and other industrial buyers shift from orderly contract negotiations to panic purchasing, premiums will gap from the current $8 to $15 above spot to $30 or more. At that point, physical silver becomes unavailable at any price that most buyers would consider reasonable, regardless of what the paper price shows on futures exchanges. Let me be clear about what unavailable actually means in this context. The metal doesn't literally disappear from the planet. Mines continue producing, refineries keep operating, and inventories exist somewhere in the supply chain. But available means you can place an order and receive delivery in a time frame that allows your factory to maintain production schedules. When lead times extend from weeks to months, when premiums exceed 20 or 30% above spot, when suppliers tell procurement managers they can't guarantee allocations regardless of price, that metal has effectively become unavailable for practical business purposes. Manufacturers face the choice between paying extortionate premiums or shutting down production lines that employ American workers. Think about the broader implications for our economy when a critical industrial input transitions to allocation-based distribution. Silver is not a luxury good or a speculative asset that only impacts investors. It is a necessary component in technologies we've deemed essential to our economic and environmental future. Every solar panel installation supporting our renewable energy goals requires silver that has no substitute at current efficiency levels. Every electric vehicle we manufacture to reduce transportation emissions contains silver in its electronic systems. Every smartphone, computer, and communications device depends on silver's unique electrical properties that no other element can replicate at comparable cost. What happens to our industrial policy when the material required to execute that policy becomes scarce? We've committed to installing hundreds of gigawatts of solar capacity, manufacturing millions of electric vehicles, and maintaining technological leadership in electronics and computing. Those commitments are not optional political preferences. They're legal requirements under the Inflation Reduction Act and various state mandates, backed by hundreds of billions of dollars in subsidies and tax incentives. But none of those commitments accounted for the possibility that physical silver would become allocation-based, forcing manufacturers to compete for insufficient supply at prices that make project economics unworkable. This isn't speculation about distant possibilities. According to dealer reports and conversations with manufacturing executives, the panic purchasing phase has already begun. Industrial buyers who've never paid attention to silver markets are suddenly calling bullion dealers asking about securing multi-year supply contracts. Companies that historically ordered on a just-in-time basis are now trying to stockpile inventory as insurance against future shortages. That behavioral shift from efficiency-focused procurement to security-focused hoarding accelerates the timeline toward genuine scarcity because it removes metal from circulation that might otherwise serve current production needs. The question for everyday Americans isn't whether to panic about silver prices. The real question is whether we understand the vulnerability embedded in supply chains optimized for cost rather than resilience. We have spent decades building an economic system that assumes critical materials will always be available at reasonable prices through global markets. We've allowed strategic refining capacity to migrate overseas. We've relied on just-in-time delivery instead of maintaining buffer inventories. And now we're discovering that geopolitical events, naval operations, trade tensions, shipping disruptions, can transform theoretical supply chains into actual shortages almost overnight. Here's what this situation should teach us about financial reality in 2026 and beyond. The systems we built assuming stable globalization are encountering a world where national interests, strategic competition, and resource scarcity override market mechanisms. When a U.S. Navy carrier group seizes tankers in the Caribbean, the immediate impact hits oil markets, but the downstream effects ripple through every commodity that travels those shipping lanes. When China controls 40% of global silver refining capacity and tensions escalate between Washington and Beijing, that concentration of strategic control becomes a vulnerability that no amount of financial engineering can solve. When mine closures remove supply that takes 7 to 10 years to replace, the deficit doesn't heal itself just because prices rise. The window to position for this reality remains open right now. But that window closes as industrial buyers shift from orderly procurement to panic hoarding. The silver available today at $72 plus modest premiums represents the last inventory standing between current market structure and allocation-based distribution. Once that inventory depletes through the combination of structural deficits and accelerating demand, the price discovery mechanism breaks down entirely. At that point, we're not talking about silver reaching $100. We're talking about silver becoming effectively unavailable at any price posted on financial exchanges because the paper market has diverged completely from physical reality. This isn't a prediction designed to generate fear or drive speculative buying. This is supply chain mathematics meeting geopolitical reality in a market where replacement is impossible and time has run out. The question facing each of us is whether we understand the implications of living in a world where critical materials become allocation-based rather than price-based. For investors, that understanding might translate into positions in physical metals or mining equities. For policymakers, it demands urgent attention to strategic supply chain vulnerabilities we've ignored for too long. For everyday Americans, it means recognizing that the stable globalization we assumed would last forever is giving way to something more complex and considerably less predictable. The $100 silver that analysts project for the second quarter of 2026 is not the end of the story. It's the beginning of a new chapter where commodity markets reflect actual scarcity rather than paper price discovery. We either adapt to that reality now while we still have options, or we adapt later under duress when the options have narrowed to crisis management. The choice, as always, belongs to those paying attention while there's still time to act on the intelligence available to anyone willing to look at the data honestly.